experience, which makes it more difficult for them to detect it. Okay. Just again, here KPMG's forensic group did this, took this fraud survey back in 2003. I think they have a more recent one, but what you'll see here is some of the factors that contribute to the risk of fraud would be things like collusion between the employees and third parties, right? And that's what's difficult to detect. So for example, companies will try to instill policies to mitigate this risk. So for example, for purchasing, a company might require that the purchasing agent be rotated on a quarterly basis or an annual basis so that they're not dealing with the same vendors over and over again. They would require that there be more than one bid, that there be competitive bidding. So they try to mitigate that. Salespeople, their job is to go out and establish relationships with customers, right? And so it can become easy for them to collude with their customers on things. So there has to be real good oversight, such as, maybe this vice president of sales accompanies the salesperson on calls, or that they have another person reviewing sales orders, looking at that, for example, or they could have detective type procedures in place where they examine that every sales person's sales order history, their order history, or their over on a quarterly basis, looking to determine whether or not there are a lot of returns coming in, right, for any particular customers associated with that salesperson. Inadequate internal controls, management's ability to override internal controls, but as you can see, inadequate internal controls definitely the biggest issue that increases fraud risk. And then to a lesser extent, a lack of control over management by directors or ineffective or non-existent compliance plans. But you'll see, and as I said, we're going to talk about controls